I'm not recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period, and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote and never pay it. You don't need to pay attention to them. I mean, the main thing to do, and you're not going to pick the bottom, and nobody else can pick it for you or anything of the sort. You've got to be prepared to, when you buy a stock, to have it go down 50% or more and be comfortable with it as long as you're comfortable with the holding.
Buy and hold forever, a strategy that's worked very well for Warren Buffett for quite some time. Some names he's held for more than 30 years, notably Coca-Cola, but even now he's starting to change slightly where he is trimming some of his larger, longer-term positions. That also includes the likes of Apple, the likes of Bank of America, and one thing that's very interesting to note is that he has not only outperformed the S&P, but from 1964 to 2024, he has done it by a massive margin, 5,502,284%, versus the S&P, which comes nowhere near. Now, we will have to say, since announcing his departure, Berkshire Hathaway's shares have been underperforming the S&P, but we really have to put this into context. They hold hundreds of billions of dollars, so they will more than likely be completely fine. In today's episode, we want to look at growth stocks that we believe could be the new buy and hold forever. And if we look at someone like Bill Ackman's portfolio, he has been adding some growth stocks that we believe could be some for consideration. For example, we have Uber here as his largest position, as well as Google, which has been one of his longer term, sitting around the 15% mark. Although some of these have been newer acquisitions, notably we have Amazon, in fact, 9.3% that he added in the previous quarter. And we want to flag some stocks that we believe do encompass Warren Buffett's buy and hold forever. And we're going to kick off with Bill Ackman's recent acquisition, and that is Amazon. Stock number one that we believe should be in every investor's portfolio is up 28% in the last year. Year to date, it is up, although it has trailed the S&P, but trading very near to their all-time highs, where Wall Street see this as a strong buy. Seeking Alpha also believe one for consideration in the portfolio, and trades at a forward valuation of 35, which we believe isn't as high as you would think, because when we look at it on a PEG basis, this includes their growth. On a trailing 12-month, they're actually trading at a 24% discount to the overall sector, and if we look forwards on a price to earnings growth, they're only trading at around an 8% premium. Now we'll get into the valuation shortly, but as we said, we are looking at growth stocks. Amazon with an A-, really highlighting last year and this year expected to grow at around 11%. Now that is slower than their 5-year average, but we believe they will start to pick up, as we will come to show. Earnings per share also expected to grow 18% over the next 3 to 5 years, well above the sector at 11, but at the moment that is lower than their 5-year average, around the 30% mark. Now their most recent earnings was very strong, top line up 13% year on year, but actually something not discussed too often is improvements to their margins. Gross profit up 2 percentage points, operating up 1, and their bottom line up 2, whilst we can in fact see their fastest growing income stream, advertising at 23%. AWS, definitely something that shouldn't go under the radar, up 17, where actually in the cloud infrastructure space, they are the number one, holding 30% market share, with Microsoft in second place at 20 and Google Cloud in number 3. And the thing they're actually doing, something they've only increased this year, is spending a lot on capital expenditures. They see this as a once in a lifetime opportunity, and that is why not only are they spending the most out of the Mag 7, but actually by quite some distance. It was expected to be $100 billion at the beginning of this year. They've now bumped that to 120. You can see number 2, Microsoft at 88. And as investors, you have to hope you do get to see a strong return on these large investments. At the moment, their ROIC is a little bit inconsistent, but in the most recent year, 12%, not too bad. Ideally, we want to see a minimum of 10, and that is something we want to see on a very consistent basis. just to give us faith management are able to allocate all of this money they're spending effectively. And it wasn't that long ago where we heard they deployed their 1 millionth robot. They're looking to really improve their margins. We can see this is expected to cut the travel time of their robot fleet by 10%, a faster as well as a more cost-effective package delivering system. And just over the last few quarters, we are starting to see that in effect in their margins, something we only expect to see to get stronger and stronger, which as an investor, we hope to see a larger bottom line. And they're very near to having more robots in their warehouses than humans. And our intrinsic value of the company gets to $228. We have derived this from the discounted cash flow model, where as you can see, we have a growth rate of 20% moving forwards. Just as an FYI, we have a low, medium, and high, something we typically use, and the numbers here are subjective. You can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, Amazon or anyone else. Now what we'll flag is when we've done a reverse DCF, actually 20% is already baked into the growth. So if you're buying this today, something worth highlighting, and we'll show you for transparency, if you believe 15% to be more appropriate, $160, downside of 30, and if you believe they can really ramp up this automation and see efficiencies elsewhere, 25%, indicating 323, 41% upside. Now we'll use the middle rate today at 20%, which actually highlights we see Amazon as of today trading at its fair price. That is why you're not getting a margin of safety, but you're also not paying a premium. Some investors more than happy to not only pay intrinsic price, but sometimes in fact a bit of a premium. As always on the channel, we like to kick off with a 10% MOS, and we would say this is a time to buy if you believe it meets our 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. Something we would say hits all of the right places for Amazon. For those that want to see 20%, a buy at 183, and those at 25, $171. Wall Street themselves, with their strong buy rating, see this at $266 into next year, translating to 16% upside. For the reasons mentioned, whilst we haven't gone into a lot of detail, this is definitely one of those we would say as a buy and hold forever. And before we move into stock number 2, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks as well as what's going in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of August. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a spreadsheet released in fact over the last few days of 29 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're moving on to isn't your average chip stock. ASML owns the most critical tech in the entire $600 billion semiconductor industry. TSM, Samsung, Intel, they are unable to make cutting-edge chips without them. And in fact, here is the biggest kicker of them all: no one in the world can build these machines. Now, if you're thinking how dominant is ASML, each one of their EUV machines cost over $9 billion and take 17 years to develop. They're also built with 450,000 parts from over 5,000 suppliers, and whilst China is spending billions of dollars trying to copy them, they have ultimately failed. So it isn't just a moat, it is literally a fortress with absolutely no current competition, and they're the ultimate toll booth, so every chip giant has to pay them, and they name their price. $200 million per EUV machine, over $350 million for next-gen high-NA units, and they're also fully booked years ahead, as we can see from net bookings. This is what we would call elite pricing power. And whilst you may think ASML is a cyclical stock, it ultimately isn't. It's a long-term compounder, 80% plus market share in lithography, no competition, critical tech for AI, smartphones, data centers. And ultimately, what can we see? Chip demand is only going to go higher and higher, and their latest earnings continues to show growth. Net sales up 23% year on year. We got the efficiencies again, gross profit up 2 percentage points, operating up 5, bottom line up 4, and they're currently in one of their largest drawdowns, which ultimately means a very strong buying opportunity. And the reason why we saw this drop is in fact in their latest earnings, they did question whether they will see any growth in the next full year, something that did ultimately get investors spooked. But one thing that is for certain, companies are not going to stop buying ASML's machine. Remember, they have what we would call an impenetrable moat, and we can see here they're the only company in the world capable of building these machines, which, as the Wall Street Journal puts here, indispensable in producing the most advanced semiconductors possible. And what are management doing with the share price that has been continuing to get hit? They're only doing more and more share buybacks. Yes, they have an authorization program, but ultimately just look at when they've started to kick up these buys. Latest quarter, we are seeing billions of dollars. Now, the company is down nearly 20% in the last year. Year to date, they're up around 8%, and over the last 10, another outperform of the S&P, up 715%. Trading around the mid to lower end of the 52-week range, a double buy from both Seeking Alpha and Wall Street, and currently they're trading on a forward PE valuation at a 14% premium to the overall sector. But actually, if we step back and look solely on a growth basis, similar to Amazon, they're trading at a 30% discount based on the trailing 12-month basis, and moving forwards over the next year, they're trading at another discount of 12%. And if we look at their historical 5-year forward valuation, 28 below 33, an undervaluation point, a yield of 1% above the 5-year 0.84, again, possible undervaluation signal, which only strengthens when we look at the blue tunnel, which, remember, does highlight the intrinsic price. We're seeing disparity now, and we're seeing disparity pretty much the majority of the last year. This really signals opportunity, which actually, when we zoom out to the last 5, we have seen more often than not this company trading at a severely overvalued level, so perhaps definitely one to sit back and take note of. Where their growth last year was 26%, it's lowered in terms of expectation, and we can see on a 5-year average, especially for this upcoming year, they are expecting to grow a little bit slower. Earnings per share, a similar scenario expected moving forwards, sitting around the 17% mark. Now, it is above the sector at 15, but again lower than their 5-year. Maybe something we will see improve if they can really show strength during this uncertain period. And our intrinsic value, $909, again derived from the DCF model, highlights today baked in growth is 9.3%. Really, if you see 10, 12, or even 14%, we are talking upside today. But remember, longer term investors, if you believe in this company, they can outperform. It could be for consideration now. So 12%, this really reflects a very, very nice margin of safety of around 18%. If you wanted 25, a buy at 681, and Wall Street themselves see $880 into next year, which translates to 17% upside. Great thing about this company, if you believe that is too high and you want to go lower at 10%, you are still looking at a margin of safety of around 5, and for a high quality company, that may be sufficient. If you want 15, well, a buy at 671, and at 25, around 592. So ASML, stock number 2 to buy and hold forever. Let us know your thoughts. The next stock is in fact Google, which is the most profitable company in the world. We can see they outshine the likes of Microsoft as well as Apple and continue to be in pole position. If we look back from 2014 to 2025, they've been growing their bottom line net income as well at the fastest rate, 22.1%, compared to second place Microsoft sitting at 15.7%. And they also recently released their earnings, which investors love. Growth was continued to be seen across their income streams, and we're starting to see a change of tune from analysts who were very bearish on Google search. They now potentially see the opposite is happening, and that AI is actually accelerating their business. And in the most recent quarter, their revenue was up 14% year on year, specifically the search continuing the double-digit growth, up 12%, but that wasn't the most impressive. Their Google Cloud up 32% year on year, their fastest growing income stream. We also note some efficiencies with both gross profit and bottom line up 1 percentage point, and investors seem to forget that within Google you're also holding YouTube. This is one where growth not only continues to climb but at a faster rate than Netflix, 18% from 2020, Netflix in comparison 13%, and we can see whilst it is slightly behind, this is something we anticipate to take over very soon, and that's ultimately down to the percentage of time US consumers are dedicating to the likes of YouTube. That is over Netflix. 2023, 8.5%. Netflix was at 7.9%. Fast forward to the latest quarter. In fact, we have data now from July. 13.4% of consumers are streaming on YouTube. When we look at Netflix, a lot lower at 8.8%. And as we said, Google Cloud growing very fast at 32%. Yes, we highlighted at the beginning, Amazon in fact does have the largest market share, but their growth was 17%. We see Google at 32%, although in the fastest position and by a very large jump from the previous quarter is Microsoft at 39%. And they're also doing something similar to what we saw from ASML, where they continue to do share buybacks. That is one way they return excess cash on top of the very small dividend they currently pay. But we should also have some consideration, as we will get a verdict at some point this month, whether or not the DOJ proposal will come through about the breakup of Google. But the company itself is up 20% in the last year, year to date up 6%, and over the last 10, another outperform of the S&P, trading not far off 52-week highs, not only a double buy from Seeking Alpha and Wall Street, but both of them very near the 4.5 to flip it into a strong buy. And keeping it consistent, looking at the price to earnings growth, you're actually paying on a trailing 12 month a 39% premium, but if they can hit those numbers over the next 12 months, it's currently trading at an 8% discount. And we also see it in fact trading lower than their 5-year forward P around the 22 mark, currently sitting at 20. And if we do look at the blue tunnel, we can see it is just inside at the bottom end, so reasonable signal / possible undervaluation, something though we have seen in the last year trading in severe undervaluation. So as always, make sure you are subscribed, notification bell is on, will make you aware when high quality companies are severely undervalued. And if we zoom out to the last 5 years, this is one of those that more often than not does trade in that severe undervaluation signal. And the growth rate currently at a B- year on year and expected this year around 13%. That is below their 5-year average at the 16-17% mark. Earnings per share expected to grow at 15, above sector at 11, but below their historical 18. In our valuation at $200, pretty much has this company trading in line, fair price, very similar to what we saw from Amazon. Bear in mind though, we're using a lower rate of 10%, so if you think we're being too conservative and see 12%, then 15% upside. Pretty much baked in now though is the 10% rate. For investors that like the company, want a margin of safety of 10%, a buy at 180, at 20, a buy at 160, and at 25, $150. Wall Street with their nearby rating have this at 220, where they see upside of 10% into the next year. But for those that believe we're being too conservative, at 12%, this highlights around a 13% margin of safety. So let us know your thoughts on Google as well. The next stock is Visa, where they process billions and billions of transactions every single year. It's one where their revenue also follows suit. Going back to 2019, they've been able to grow their revenue 10% every single year. And if we just look at the most recent quarter, well, top line was up 14%, where we can also see transactions up again 10%. There's also been no slowdown in consumer spending, something we saw from their latest earnings. But one thing we would say to have in consideration when looking at this company is whether or not you believe stable coins will be a real threat, and that is why we have seen it pull back from their 52-week high, something some investors may see as a great time to buy the dip, currently still trading in the upper end. It's also up 29% over the last year, 9% year to date, and like every company today, outperforming the S&P up 374%. a buy from Seeking Alpha, a near strong buy from Wall Street, but unlike the previous two companies, when we look at their PEG ratio, they're actually trading at a very large premium to the overall sector, but actually this is one, like MasterCard, that is 150% worth the premium. Their growth, as we'll come to show you, is very strong. And in a forward valuation, pretty much on both cases, when incorporating yield as well, it's not too dissimilar from the 5-year. Hence, when we get to the blue tunnel, like the majority in the trailing 12 months, this one has been within this, although right now sitting slap back in the middle, another reasonable signal. Something that when we zoom out to the last 5 years, we do find it incredibly rare to see it ever trading in a severely undervalued space. But this one is just what we would call a very, very consistent company, expected to grow 11% in the next year, the same as the last year, and whilst being a lot better than the sector, is actually one, unlike the previous ones today, where it is growing in line with their historicals. EPS 13% projected, above the sector, but a few percentage points below the 5-year average. Now, our intrinsic price, $349, is derived using a 12% growth rate. As you can see, 11.8 is already baked in. If you believe the median rate today to be most appropriate, which as always, you can grab a copy of this by clicking on the pinned comment below, gives rise to a very, very small MOS at 2%. If you want 10%, well, a buy at 314, at 20%, a buy at 279, and at 25, 262. Wall Street themselves see this as a great opportunity, 405 into next year, 18% upside, and for those that are more in tune with what Wall Street see moving forwards in terms of growth, they see this 405 intrinsically at the upper growth rate. It comes to 402, which means as of today, a 15% margin of safety. That is where we would say Wall Street believe the company sits. Let us know your thoughts on Visa. The next stock is Nvidia, which not only became the world's first $4 trillion company, but is currently the only one. And they've got some good news for investors, as recently we heard they're now able to sell to China, something that was restricted by President Trump, although they do need to give 15% of those specific chip sales to the US government. And the company's numbers are so strong that unlike others where they compare their performance on a year-on-year basis, they're actually comparing it to the previous quarter. Now, they're due to report later this month, but in their most recent earnings, data center was up double-digit from just the previous quarter, with total revenue up 12, and the reason why we saw deficiencies, as noted here in brackets, is due to those restrictions that they had to write off some of their inventory. But we can see revenue continues to climb quarter on quarter, quite a large jump in fact from the beginning of 2024. No surprises, the main contributor of this is the data center segment. Now, they're on a phenomenal run, up 37% over the last year, up 33 year to date. Over the last 10, one of the very few companies that has been so strong in this period, up more than 31,000%, trading right there near 52-week and all-time highs, with a strong buy from Wall Street at 4.58, a near buy rating from Seeking Alpha. And you'd be surprised to note here, whether you look on a price to earnings growth on a trailing 12-month or a forward-looking basis, on both accounts against the sector, they are trading at a discount in the 20% region. And they're also looking undervalued if you want to see the forward PE of 36.5 versus the 5-year average of 41.4. And that's also reflected in the blue tunnel. Great to see it increase, but there's still disparity, although very slightly. So we would say perhaps a reasonable signal too. And actually, if we zoom out to the last 5 years, or more importantly, just in the most recent period, this one has given investors many times to buy this at a severely undervalued level. And as expected, their growth looking very strong. Revenue up 86% last year, expected 61 this year. No comparison at all to the sector, but they're also growing faster than their own 5-year average, something that is expected to follow suit on the earnings per share. 30% projection, sector low at 15, and their own 5 years slightly below at 29. And our intrinsic value at $164 is using a 20% growth rate. You could argue extremely conservative 5-year and 10-year growth rate in the triple digit, with right now 21.3% being baked in terms of growth. So this actually gives a premium of 9% on top of Nvidia. For those that want this at a 10% MOS, a buy at 147, at 20, 131, and at 25, around 123. Wall Street, strong buy, see this at $200 into next year, 12% upside, and for those that believe these are too conservative, well, at 25%, as we can see here, $229, actually indicating a 22% margin of safety. No list can really be complete without Nvidia, but let us know your thoughts. And don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.